Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blikre, your host, and with me is the people's voice, Sydnee Freed. Kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming Emily Roland, who is the co-chief investment strategist at Manulife John Hancock Investments. Thinking about recent market action, something seemingly broke. Today we are going to flesh out some of the insights as to how and why. Our word of the day is correlation. We know it doesn't necessarily mean causation, but why are market correlations breaking down? And this episode is brought to you by the number 17.9. That is the most recent low in the S&P 500's forward multiple. It cratered during the market sell-off, but where does it go from here? As corporates pull guidance in the face of uncertainty. So Emily, just break it down for us. What's your big picture overview of everything that's happened so far this year?
Well, that's
in 30
such
seconds
an
or
easy
less?
question. I think one of the most remarkable cross-asset dynamics that we've seen is this kind of end of U.S. exceptionalism narrative and the massive outperformance of Europe. And I know we may talk about that in just a bit, but just seeing these huge rotation and capital flows away from U.S. assets, whether it's stocks, bonds, the dollar, and seeing non-U.S. markets really get a lot of love here. There's almost like a halo effect around anything European, whether it's euros or European stocks or bonds there. So really notable cross-asset dynamics. And I would say kind of the breakdown between treasuries and the U.S. dollar last week was really notable as well.
Yeah, we're going to explore that, and this is a perfect segue into our word of the day, which is correlation. The correlation measures how two things move in relation to each other, like stocks or interest rates, and a strong correlation means that they usually rise or fall together. We can also have negative correlation, which means they're going the opposite direction. So let's talk about what we saw last week. And by the way, we're taping this 1 week after we saw that huge market meltdown. And then, by the way, in the middle of the week, we had the best day for the S&P 500 in a really long time. So what do you think about these correlations in the dollar and yields kind of breaking down?
Yeah, something felt like it was breaking in markets last week, and it was really notable to watch the yield on the 10-year Treasury go up at the same time where inflation missed. We got a softer CPI report, shelter finally, 0.2%. month over month. PPI then came in softer as well, and the City Economic Surprise Index starts rolling over. And then meanwhile, Treasury yields are backing up. I don't know if you guys remember in Sesame Street that song, one of these things is not like the other.
Yes.
I'm like, this makes no sense to me right now. And then meanwhile, you're seeing a weaker dollar, which usually dollars have a high correlation with Treasury yields.
Yeah, they were going up and down together for yields.
For a long time, and that broke down. So there was a bunch of different narratives that started going about why we saw this divergence happening. Who's selling treasuries? Is it China? Some other larger holder? Maybe a big institutional player out there? Really hard to quantify exactly what was going on. But then, of course, we saw Susan Collins from the Boston Fed come in on Friday, kind of calm everything down a little bit by saying, hey, the Fed will intervene if there's some type of,
Nothing like a Fed put on a Friday afternoon.
Yeah, exactly, right? So that's what we're seeing.
What's a normal correlation? When you said the 10-year went up and inflation missed, what would be a normal correlation?
Yeah, so normally what would happen with inflation lower is it would bring bond yields down. So if you think about why the 10-year Treasury yield moves are on what, it's not really the Fed. Most people think that it is, but it's actually like growth expectations and inflation expectations that drive the majority of those moves. And they move together really, really closely. So it's just strange to see that dynamic play out.
It's interesting. Let's hit on that point for a second. The Fed controls short-term interest rates in the U.S., and I think that's what you're talking about. They don't explicitly control the 10-year yield right now, longer-term yields. I say right now because historically sometimes they have. We had Operation Twist in the 1960s and then again in the 2010s. Do we see something like that coming up again? Or, the Fed, Susan Collins' comments, it seemed like she was ready to say the Fed's ready to intervene in the market, but are they willing to go out on the curve?
Well, I don't know the answer to that. It's certainly possible. And the Fed has a lot of things in their toolkit. I was trying to remember this morning all the different names of the facilities that the Fed set up over the years.
Alphabet soup.
The alphabet soup of it all. And I almost, I went kind of back in my memory for those things. And it's possible. And that's really, I think, what is, again, calming markets is the ability of the Fed to intervene if there's any type of dislocations playing out. And I think they certainly will. In what form, I don't know. I mean, if you just remember back to COVID, the Fed actually bought bonds, high yield bonds.
Corporate bonds. Corporate bonds, something that they're really not supposed to do, except in emergency times. Just thinking about those alphabet soups, we had a lot of those in the pandemic. I think my favorite was MMM. FL or something, liquidity facility. It was a money market mutual fund liquidity facility.
Nice.
Anyway, that wasn't even a question, but what
could have bingo.
My question, if they did intervene with the 10-year, how does that work? Like what actually happens?
Well, there's lots of different things, but they're basically like providing liquidity to the market. So they could do things like lower overnight lending rates and basically make it easier for banks to lend and for the market to function correctly.
Yeah,
would that like kill markets though? Like is Fed intervention seen as like a like desperate, like, oh no, and then stocks drop? Or
well, the desperate oh no moment happens like before the Fed intervenes.
That's when the Fed is cutting 50, 100 basis points at a time.
That's not good.
When the Fed cuts a bunch at once, you know something has hit the fan.
Exactly,
Getting back to correlation here.
Yeah.
What about the rest of the market? This bull market was kind of predicated on the AI trade. That has definitely fallen off a cliff, as most things have. Does it come roaring back? Do we need a new paradigm for a new bull market?
Yeah.
Do we get a little bit of the old? What do you see happening?
So one of the most notable things that we're pointing out is that the highest quality assets are the ones that have gotten sold off the most this year. So it's US mega cap tech. To your point,
Cash stocks.
There was a major valuation problem. We came into the year with the S&P 500 growth index trading at almost a 50% premium to its 20-year average. So that means people were willing to pay a lot for the future earnings of these companies. And meanwhile, we got back-to-back 25+% returns on the S&P 500. So we just came into the year with a tough starting point. And what went up the most is coming down the most. But when you look at what the playbook has been, it's like German industrial companies and European banks. Like, that's not a great tariff playbook to me.
That's hard to get excited about,
It
too,
is.
for Americans.
Exactly.
Because that's been dead money forever.
It's dead money, and the earnings aren't that great. If you look at where the best earnings growth is, it's still in the United States in large cap companies. So I think there is an element of the baby getting thrown out with the bathwater here as U.S. sentiment shifts to a great extent, and there's going to be some value that opens up within some of those names.
If there was a valuation problem, then is re-rating the right word here?
Or
like
de-rating.
De-rating, like is it a good thing then that we're seeing them stocks come down a bit?
I mean, part of it is a healthy reset. Like we were talking about, again, this 50% return over 2 years, and three-peats are really hard. I was Googling like sports analogies for. That's the one I came up with. But it didn't seem to hit that well with the people I was talking to, so I gave up on that. But three-peats are tough, and the valuation reset, I think, was healthy. But the challenge is nobody really knows right now what the E is. So stocks have gotten cheaper. On the PE ratio, there's a lot of uncertainty around what is the earnings estimate right now. So yes, prices have come down, but stocks may not be as cheap as they look because the earnings probably has to adjust lower. And we're starting to see some of that with earnings season.
Yeah, I think we're going to talk about earnings, but do you think we haven't seen the worst of the D-ratings yet? Do you think, because we're in the beginning, we're still in the beginning of earnings season. We've got a few companies pulling guidance. I mean, frankly, not as many as I would have thought, but how do you see this evolving?
Yeah, I mean, analysts are still penciling in 10.5% earnings growth for the S&P 500 this year. I think that likely needs to come down. They haven't really put pen to paper in terms of those write-downs yet. This quarter, we've gone from 11 to 7, so the bar is a little bit lower. But corporate guidance is really interesting right now. I don't know if you noticed, there was an airline this morning that gave two sets of guidance, one for severe tariffs and one for kind of more benign tariff scenario. I think it was nice that they gave something.
Yeah, that's generous.
It was very creative, I thought, but I think guidance is going to be a bit more difficult to come by because CFOs and CEOs are sitting around and trying to model for something that's never happened.
They're producing choose-your-own-adventure earnings releases.
Yep.
So let me ask you about Wall Street predictions, because we've seen the widest disparity in what people think the S&P 500 is going to end at the end of the year.
Yeah.
In the history of this time series that I've seen, going back like 25 years to the beginning of the century. So what do you make of that?
Yeah, I mean, there's always been a wide band with like a really tight, median estimate. So we've tried not to go there because it's really difficult.
Or to be one of the outliers?
Yeah, exactly. But I think what you're going to see is not a lot more multiple expansion. So we just had extraordinary, I mean, it was really the bulk of the returns that we saw the last couple of years. So I think you probably get a little bit of a contraction in multiples, and then you probably get the earnings coming down to maybe mid-single digits from where they're penciled in now. So I think like a low single-digit return is probably within the realm of possibility in our view.
Not terrible.
No.
What areas of the market do you like right now?
Yeah. So we talked about kind of meh on stocks, right? Just the starting point. That's a technical word we use at John Hancock.
Meh?
MEH.
Meh.
Yeah, MEH. No, just kind of benign, like not great, earnings, probably multiple contraction. Stocks aren't really on sale yet. Bonds are. So we're looking at the income that's available in high quality bonds as being something that can play a bigger role in portfolios. It's income over capital appreciation for us. And we're looking at any backup in bond yields as really a gift that the bond market is giving us to lock in those elevated yields.
We've had guests, RIAs on the show that say, give me 5% in the 30-year, back up the truck on that. We will take that all day long. And we saw that recently. We've seen 5% in the 30-year twice in the last couple of years. And I think they were both buying moments for bonds.
Yeah, I mean, we're not talking about extending duration that far because there's a lot of volatility way out on the curve. But I think just looking at a intermediate part of the curve, belly of the curve, like a kind of benchmark level of duration. I'm talking boring bonds, like investment grade corporate bonds, mortgage-backed securities, treasuries. And I think with the ag getting close to 5%, we would look at that as a really attractive income. And most importantly, the most popular investment of the last year has been money market funds, like by far. And this idea that there's $7 trillion of cash sitting in money markets, we're suggesting getting some of that cash off the sidelines and redeploying it into high quality bonds just to take advantage of the ability to lock that income stream in for years.
Yeah, what's really interesting about that, we can touch on this after the break if it comes up, is that there's a delay. The Fed lowers rate and then you got all these trillions on the sidelines. People don't seem to realize right away that those rates are going down.
Yeah.
But we got to leave that there. We're going to take a quick break. But coming up, we are talking earnings and a runway battle for foodies over the best place to get served some tasty market victuals. This episode is brought to you by the number 17.9. That is the most recent low of the S&P 500's forward earnings estimate that we saw crater during the market sell-off. So where do we go from here? We were talking about corporates pulling their guidance. Do you see earnings as, how severe does the derating that we were talking about get, do you think? And what's the bear case? What's the bull case?
Yeah. So we've seen a number of the big banks revise lower their estimates for earnings. We watch that closely. We're looking at kind of towards 250 on an EPS basis. I think looking at year over year earnings growth right now, again, it's at 11. I think maybe you get to more half of that is probably more realistic in a decelerating growth environment. I think the challenge is that companies are frozen in a lot of ways right now in terms of making a decision. Now we have these 90-day delays on tariffs. We're kind of waiting for more information around that. So I think that kind of puts us in this wait and see pattern as far as forward earnings estimates go. But what I will tell you is that in the United States, we still have superior earnings estimates. There's stocks with great earnings growth prospects here that are now trading on sale. Meanwhile, the rotation's been to Europe where the earnings are lower quality. So still like the US for better earnings growth here.
What sector earnings-wise are you looking forward to seeing most?
So this quarter, healthcare is expected to see the most outsized earnings. We've been overweight the healthcare sector. We've had to be a little bit patient there.
It's shown no love.
None.
Even the flows have been bad, but it has picked up.
Why would you need a healthcare stock if you can own NVIDIA, right? No, just kidding. But I think that's the challenge. It's a more defensive sector. It's about the stuff that people need versus what they want. And right now we're seeing consumers pulling back a bit. They're showing signs that they don't want to make big purchases. We also like the utilities sector. It's about embracing the things that people need to do versus the stuff they want to buy.
Also an AI play, or do you think that segment of it is a little bit dead?
Yeah, and I think utilities have done well because of the ideas around power generation and AI have really helped the sector, but we think there's a pretty long runway there as well.
But we were talking about US stocks not doing as well right now, but then our healthcare and utilities, these seem like opportunities for people. Is that right? If you're searching, if you do still want to deploy your their cash into stocks, this seems like a good spot.
It is, and they're still on sale. Healthcare is trading at a 20% discount to the broad market. Mid-cap stocks are another area that have kind of been left behind that are trading at a 30% discount to their large cap counterparts. They're higher quality than small caps. So we like mid-caps as kind of the sweet spot in terms of U.S. equities right now as well.
I want to circle back to kind of the beginning. We were talking about correlations, and we mentioned the U.S. dollar had a huge drop. And I want to tie it into earnings, because a lot of times when a company needs a good excuse for missing, it's currency issues. And we've seen this before, but we just got the B of A Global Fund Manager survey for, I believe it was, April.
Yeah.
And the dollar, their positioning and the expectations, the sentiment on the dollar is extremely negative. And yet it is in this 3-year trading range. It just kind of dipped below. I'm thinking that is a perfect time for a rally that just catches everybody off guard. What do you think about that, Dan?
So by using traditional inputs into figuring out currency dynamics, which is really hard, by the way, but usually you want to think about where's the best relative economic growth and where's the best relative earnings growth, and it's also looking at divergences in central bank policy. So by all intents and purposes, the US dollar should be stronger. Our economy, I'm not saying we're great, but we're kind of the cleanest shirt in the dirty laundry from an economic perspective here. If you look at central banks, the Fed's on hold, at least for now. Other central banks globally are cutting. We also have much higher sovereign debt yields. That should be bringing a flow of dollars onto our shores. We talked about all the reasons that it's not, but the dollar should be stronger. Now, I'm always looking for positives about things. The dollar weakened people are like, where's the good news? The dollar weakened in the first quarter meaningfully, and that should be really helpful to U.S. companies who have a lot of their revenues derived from overseas. 40% of revenues in the Russell 1000 index come from abroad. So I'm waiting to hear from CEOs that this is a key theme that their earnings are going to show us in the first quarter.
Unless they weren't expecting it and they were hedged the wrong way or something.
There you go.
Who knows? All right, time now for our Runway Showdown, and today we are serving up a tale of 2 kitchens. First to sizzle, the pop-up bistro. This is Europe's surprise comeback, a trendy minimalist menu with bold plating and rave reviews. Investors, they are flooding in, drawn by a surging euro and the promise of something different. But peek behind the kitchen doors and the fundamentals are under seasoned, Sid. Earnings are getting cut, sentiment slipping, and industrial production, it just missed. Meanwhile, still flipping orders under fluorescent lights, the 24-hour diner that is the USA. Reliable, fast, and built for scale, she's fed generations of global portfolios with high turnover and dependable output. But lately, the booths are not quite as full. Burned by recent specials, some diners are heading for trendier spots. So Emily, which kitchen do you trust to deliver this year? The European pop-up that's hot right now, or the American classic that might just be resting for a return to full occupancy?
I mean, my brain is flooded with so many possible ways to build on this analogy. It's almost too much to handle.
Too much.
We got 5 minutes.
I am a classic burger and fries kind of girl. I don't need the fancy stuff.
Nice.
So I think the U.S. is still the place to be. It's not that we don't have an allocation to international markets. Once in a while, you want to go to a French restaurant and have some nice wine, right? So we still have it in portfolios. We're just modestly underweight given the better relative economic and earnings trends here in the United States. I think it's tough to bet against the U.S. over time. I think Warren Buffett had a phrase like that at one point. And so I think we want to follow the earnings. You want to follow the economic backdrop. And here that we favor the U.S. Opportunities internationally, I think you've got to get active. I keep trying to bring the restaurant thing back in, but I'm not.
I can see you thinking.
Yeah, I'm trying to go there. You want to think, so in our world, we're looking to overweight international value stocks over international growth because the relative earnings trends are better there. It's kind of the opposite of the United States. So we think an active manager that can identify stocks with good earnings growth prospects, I think makes a lot of sense in that environment.
If you're really new to investing in anything overseas, where do you start? Is it safe to just do an ETF from another country and call it a day, or how would you recommend?
Yeah, you can do that. I think, going up in market cap internationally is something that will allow you to kind of manage the volatility a little bit better. I think an active manager is really important actually internationally, just because there's a huge difference in earnings trends. Like I said, growth versus value, up in market cap versus down in market cap. The thing to remember about European indices is that they're very cyclical. What I mean by that is the sector composition means the types of stocks that you own in Europe tend to move with the global economic cycle more.
That used to happen here in the U.S.
And the U.S.
What happened?
We just have a gigantic technology sector in the like we've had to create like new sectors with new names because tech
Communication
just got
services
so big.
because tech was too big.
Exactly. Yeah. So I think in Europe, your biggest relative overweights are going to be financials and energy companies and materials. Yeah. So you're just going to get a lot more of that sensitivity. The best time to own it has typically been like coming out of a big contraction in global economic activity when taking more risk gets rewarded. I don't think we're there right now. It's really just about that relative sector composition. So I think something up in market cap with higher quality and maybe more value would be the way I would start.
Do you have a percentage that you just recommend people invest internationally? 2%, 4%, or nah?
So if you think about the broad equity exposure in a portfolio, like a 60-40 portfolio, our long-term strategic recommendations would be a third of that would be in international. We're kind of closer to like a quarter of that right now, just kind of given some of our views. But diversification helps. I mean, think about the first quarter. U.S. stocks did not do well, and diversification worked for people that had international equities. The dollar weakened. So it's important to keep that in a portfolio, but you just want to think about sort of making tweaks based on what's going on around the world.
We got like a minute left here. Any final word for investors? Anything on the table here?
Yeah, I mean, I think it's a tricky time right now. It is so easy to get like turned into a pretzel dealing with all of these headlines around tariffs. Because
most of my mornings.
Right. I mean, we all wake up and there's a new headline and it might be the opposite of what you heard the day before. So I think trying to trade on that is just fraught with a lot of risk. I know it's difficult to minimize using politics as an input into making investment decisions.
Because it's always there, just blasted in front of you.
It's just there in our face more than it's ever been. But I think turning off the TV, like unless all of us are on it, then obviously keep it on.
Of course.
And thinking about, more longer term trends that we've been talking about today around cycles and earnings. Like we're investing in companies, not countries. And I think that's something really important to remember. And the 60-40 portfolio is, I think, alive and well here.
Because I didn't ask about that, but it seemed to be dead for a second.
It was for a minute.
Or a few years.
I think it was on life support for a few days, but we're back.
Very good. Well, we have wound things down here at Stocks in Translation, so be sure to check out other episodes of the show on the Yahoo Finance site and mobile app, also on all your favorite podcast platforms. So be sure to leave a comment, and subscribe wherever you get your podcast. We'll see you next time on Stocks in Translation.